In this video, I'm going to be discussing when to exercise your incentive stock options. You own incentive stock options and aren't for sure when to exercise. Your incentive stock options are a high-stakes balancing act. If you get it right, you enjoy newfound wealth. Get it wrong, and a lot of your savings go down the drain. Exercising at the wrong time can subject you to a tax approaching a shocking 50%. And yes, one single day can make the difference. My friends, welcome. It's Riley Hale here, financial advisor specializing in equity compensation. Before we get into things, I want to clarify really quick that there are two different kinds of stock options. The ones that I'm talking about and the ones that I'm not talking about. One is a slice of ownership in a company, and the other is betting on the prices of stocks in the stock market. To be clear, the stock options that I'm talking about is about the slice of ownership in your company pie. There are two different times when you can exercise. One is going to be pre-IPO and the other is going to be post-IPO. But I'm actually going to divide it into three different times to exercise. First, pre-IPO, second is approaching an IPO, and the third is going to be post-IPO. I'm going to address the pros and cons of each exercise time frame to help you make the best decision for your personal situation. And with that said, wait, did you just say that you're going to sue me under your breath? So are you going to sue me? No, I asked you. Now I have to leave this disclaimer up here. Implementing these strategies that I'm about to describe requires professional help. I am not liable for what you do with the information provided in this video. First, let's discuss the benefits of exercising pre-IPO. The first benefit of exercising pre-IPO is that you have more choices on when to exercise and when to sell. When a company is private, you generally have fewer chances to sell your private equity. The company decides when to sell its shares, not the employee. Occasionally, when the private company opens the window allowing its employees to sell through something like a tender offer, accounting protocol requires that the shares that are going to be sold be exercised at least 3 to 6 months prior to selling. So if that's the case, doesn't it make more sense to exercise sooner, allowing you to take advantage of that small window in which to exercise? Yes, exercising sooner will give you more opportunities on when to sell, especially for private companies, seeing as they only open up those windows every once in a while, versus those who didn't exercise early, they can't sell when something like a tender offer happens. Accounting protocol and various restrictions definitely surprise unsuspecting employees who didn't exercise in advance. Now that you've watched this, you won't be surprised. You're welcome. And unfortunately for some of you, it's going to be too late. Another example is if you're wanting to exercise upon your company going public. The problem is though, is that there's 3 to 6 month window called the lockup period where employees can't sell their stock and sometimes even exercise their stock options. That period can be even longer for upper management and those in the know with sensitive information. If you don't exercise early, this can be a barrier to your plans, whereas those that exercised early have more options before the lockup period begins. Benefit number 2 of exercising pre-IPO, smaller alternative minimum tax. One thing to clarify before I continue on is going to be the acronym AMT, which stands for Alternative Minimum Tax. I won't get into depth here, so check the link in my description for my video about alternative minimum tax. The difference between the strike price on the date of grant and the fair market value on the date of exercise is known as the bargain element. That spread is the amount that your AMT increases by. By exercising early, that spread or that bargain element is smaller because your company is worth less. With a smaller spread, you may avoid AMT altogether. In the case you do become subject to it, it'll be much smaller because again, the company is worth less at the beginning versus as time goes on. Exercising sooner is one of the many strategies used to avoid AMT, in addition to income shifting, AMT crossover, and deduction clustering. Remember? Wait, you don't remember? We talked about this? You and me? Oh wait, you must not remember. Silly me. Well, you're in luck because I filmed a video on it and I put it into a playlist on my YouTube channel. I add to it often, so it makes more sense if you just subscribe to my channel so you can keep up to date on all my videos. I actually left a link to this video and this playlist that I'm talking about in the description, so make sure to check it out after you finish watching this video. These strategies take some serious planning beforehand and in advance, so don't delay taking action. Benefit number 3 of exercising pre-IPO is the potential AMT avoidance. When you exercise your shares, you get a positive AMT adjustment, meaning you may have to pay AMT. When you sell your shares, you get a negative AMT adjustment, which means that you get those tax dollars back through a credit. By exercising your shares as they vest, for instance, you're inadvertently staggering the selling and exercising of your stock options to the point where the taxes and the credits offset each other. You're effectively utilizing previous AMT paid to offset future AMT liability by selling. This makes exercising so much more affordable knowing that you can manipulate the AMT in your favor. AMT is one of the biggest expenses when it comes to exercising your incentive stock options. Benefit number 4 of exercising pre-IPO is retaining your tax savings. Incentive stock options have tax advantages, namely the capital gains tax rate and the avoidance of payroll tax. The term that is used to describe this tax advantage is qualifying disposition. And there are 2 things to do in order to retain this qualifying disposition, or these tax advantages. The first I will discuss now, and the second I'll get to in just a minute. To retain qualifying disposition, the first thing that you need to do is make sure that you exercise within a specified time frame. By exercising early, you increase the likelihood that you retain that qualifying disposition or that tax advantage. For those that neglect their stock options, they run the risk of losing the qualifying disposition and as a result pay more taxes. Have you missed that window? Unfortunately, there's a slim chance you get that back. Unless you're wanting a potential 24% increase in your taxes through payroll tax and short-term capital gains tax rates, I would suggest exercising early. Let's discuss this window even further. Most people have a 10-year window from the date of grant till the time that they need to exercise by in order to keep the qualifying disposition. And for those who own more than 10% of the company's stock, that window is even smaller. It's generally 5 years. Now, if you're leaving the company or retiring, that window gets even smaller. You will have 3 months from the date of termination to exercise your options, and that is termination without cause. If there's separation with cause, such as fraud, dishonesty, serious misconduct, or disclosure of trade secrets or the like, the plan administrator has the right to terminate all of your stock options. That is total forfeiture of all your options, both vested and unvested. If, on the other hand, there is termination due to retirement or death or disability, you generally have 1 year to exercise. Just note that qualifying disposition or the tax advantage expires on the earlier of these deadlines, whichever comes first. So if you just left the company and you think that you have 3 months to exercise, but that 10-year window closes tomorrow, you don't have 3 months to exercise, you have till tomorrow to exercise in order to keep your qualifying disposition. This is one of those things where there is no wiggle room on. Just like in school when your teacher warned you,
there is no late work in real life. It doesn't matter if it's an accident, or if you turn it in 1 minute late, or if you forgot. No late work in real life. Nope. No, not accepting it.
So don't let this happen to you. Check your grant notice so you can ensure what your exact deadline is, because these dates vary by company. Exercise early. It'll increase the likelihood that you keep your tax advantages. Benefit number 5 of exercising pre-IPO is starting the tax advantage timer sooner. Remember that term, qualifying disposition? Well, here it is again. In addition to exercising within a specified time frame, the second requirement to retaining qualifying disposition is this: don't sell unless it's been 2 years from the date of grant and 1 year from the date of exercise. Exercising sooner will get you to qualifying disposition sooner, effectively locking in those tax rates sooner. As mentioned in benefit number 1, opportunities to sell your equity at a private company are far and few between. And when they do pop up, it hardly seems that there's enough warning. As such, you'll want to ensure that you have locked in the qualifying disposition or the beneficial tax treatment before one of these opportunities arises and surprises you. It'd be really unfortunate if one of these opportunities to sell actually opens up for you and you haven't waited the 2 years from grant and 1 year from exercise, because if you need the money and you have to sell during one of these windows, you have to pay the higher tax rate. But taxes aren't that bad, are they? If done right and qualifying disposition is retained, you have the possibility of paying 0% tax on the gains of your incentive stock options. In order to obtain the glorious 0% tax rate, you're gonna have to implement strategies in advance to get yourself into lower income tax brackets. It's much easier to obtain these lower tax brackets when you're not making as much money, which happens to be when you're at the beginning of your career, which is just another reason to exercise early. Paying taxes sooner may mean paying less in taxes. Ultimately, exercising earlier gives you much more opportunities to manipulate the taxes in your favor. I'm gonna pause right there and share with you a bonus. But before I get to the bonus, I'm gonna ask you to be the champion really quick and share this video in your company Slack channels so that your coworkers can get help with their incentive stock options too. And my sharing of the bonus is completely dependent upon you sharing this in your Slack channel. So until you do that, don't expect no bonus. Okay, before we get into the risks of exercising pre-IPO, I'm gonna first share this secret with you. This secret bonus is called early exercise. I know that's kind of confusing because we're talking about exercising early, but this is physically titled early exercise. An early exercise is where employees exercise their options before they even vest. And not all companies offer this, so this may or may not be applicable. Ask your employer or check your grant document to see if this is a possibility for you or not. This is mostly applicable for those first few employees at a startup that's less than a year old. And in addition, depending on your personal financial situation, this may or may not make sense. So again, here's just a friendly reminder to work with a professional. And if it is applicable, you might look into making the 83B election. An 83B election is where you choose to freeze the bargain element for AMT purposes. While the 83B election doesn't usually apply to incentive stock options, this is the rare case where it does. Just remember that it only works for exercising unvested shares. If you truly are one of the first few employees of a startup, you should look into the tax benefits of qualified small business stock. I discuss it in another video, again, link down in the description. Let's dive into the risks of exercising early. The first risk of exercising pre-IPO is risk of loss. One risk of exercising sooner is that you're paying taxes and purchasing something that could be deemed worthless in the future. Because not all companies take off, there's inherent risk with purchasing your shares and paying taxes on them. If your company fails, you might not be able to write off some of those losses. It's important to exercise if you're confident in the future of your company. It's also important to make sure that you can afford to exercise your shares and you can afford to lose what you have exercised. Just like all good investment advice, only invest, or in this case, exercise what you're willing to lose. A good rule of thumb is to not exercise more than 10% of your net worth. In addition, a major concern is exercising your shares and incurring a large AMT bill in which you'll have to sell some shares in order to pay for the AMT. But because you're pre-IPO, you might not have an opportunity to sell those shares. So make sure that you have enough cash stored away beyond your emergency fund that you can use to pay for your alternative minimum tax. The second risk of exercising pre-IPO is going to be liquidity risk. The sooner you exercise, the sooner you lose the liquidity of your cash or savings. When you exercise, you have to pay for those shares. This ties your money up into something that you're not for sure if-when you'll be getting back. Take this into consideration before you exercise and make sure that you have adequate cash to cover your needs for the next little while your money is locked up in this investment. Do you need money for a down payment, an education, or other big purchase? If yes, you might consider finding a balance between having enough cash on hand for those big purchases and having enough cash to purchase and lock up in your incentive stock options. Now let's dive into the pros and cons of exercising as you're approaching an IPO. The first benefit of exercising as you approach an IPO is you optimize your liquidity. If you want to minimize the amount of time that your money is tied up into the stock option, then exercising right before the IPO may be the best option for you. When you exercise, you have to purchase the shares at the grant price, effectively tying your money up until you're able to recoup it later. The shorter amount of time that your money is locked up, the more access that you have to it for other financial reasons. There are effectively two periods where your money should be tied up. The first one is going to be waiting for qualifying disposition, which is a year, and the second is going to be the lockup period, which is generally about 6 months. Rather than waiting for a year for qualifying disposition and then tacking another 6 months onto that during the lockup period, if you want your money tied up for the least amount of time possible, then why not overlap these two periods? This will minimize the amount of time that your money is locked up in the investment, and by the time that this period finishes, you have two wonderful things: qualifying disposition, or the best tax rate, and you have liquidity. Meanwhile, those that exercised earlier, they have their money locked up for longer periods of time. Depending on how much cash that you have lying around, liquidity may or may not play an important role in your personal financial situation. Benefit number two of waiting to exercise until your company is approaching an IPO is that you have a smaller risk of loss. If your company is approaching an IPO, that generally means that your company is doing something right and your shares are probably worth something. Would you trust your investment in a company that just started a month ago or one that has approached the point of IPO? Case in point, waiting for the news that your company is looking to IPO just ensures that your company and your shares have value to it and that there's a potential future payout for you. Now let's discuss the risks of exercising as your company is approaching an IPO. Risk number one is that your company might not IPO after all. The fact is, not all companies take off. In fact, that's why they call it a unicorn, because it's so rare to reach the valuation of over $1 billion, which I think I've seen more unicorns than I have seen billion-dollar companies. If you're waiting for an IPO and that event never happens, then you practically just wasted that time when you could have exercised sooner, met qualifying disposition, and sold your shares through something like a tender offer. Risk number 2 of exercising as you approach an IPO is that you have the potential to pay more taxes. Because you're waiting a longer period to exercise, that means that the company has more time to grow in its valuation. The AMT could be much higher because that spread or the bargain element is much larger. And if your incentive stock options lose their qualifying disposition, also known as disqualifying disposition, then your tax bill could skyrocket. While company growth is a good thing, waiting until your company files for IPO to exercise just raises the stakes with your taxes, and it requires even greater planning on your part. If you'd like some helpful tips regarding your personal financial situation or your personal incentive stock options, you can schedule an appointment with me down below for 30 minutes for free. This offer is subject to availability, so hustle to that link and schedule an appointment today. Lastly, I'm gonna discuss the pros and cons of exercising post-IPO. Benefit number 1 of exercising post-IPO is that you know if it's in the money. In the money means that you have something to gain by exercising. You wouldn't exercise if you lost money. For example, you wouldn't pay $5 for a share if it were only worth $1. When a company is public, you know the exact amount that your shares are worth on a second-to-second basis, and because you have that exact amount, it's easy to plan around. On the other hand, while a company is private, it's hard to know if you're in the money or what your shares are worth in that exact moment. Private companies are only required to get their stock valued once a year through something called a 409A valuation. There can also be valuations when a round of funding is secured, so you have the potential to be dealing with a number that's a year old. If you exercise after an IPO, you don't have to wait for that annual valuation. You can know exactly in that moment if you're in the money. The second benefit to waiting to exercise until after the IPO is that you have the highest amount of liquidity. It's much easier to sell public stock than it is to sell private stock. When you exercise post-IPO, you can sell your shares super easily. That said, just because these shares are more liquid doesn't necessarily mean that you should be selling immediately. Remember the timing around qualifying disposition. It's 2 years from the date of grant and 1 year from the date of exercise in order to retain those tax advantages. In the case, however, if you need quick access to cash, exercising post-IPO can be a great option. Something else that's really important to address when your shares become liquid is remember the importance of diversification. I've heard it put this way before. If you were given $5 million in cash, would you then take that cash and go to the stock market and buy $5 million worth of your company? Or would you buy something else? As soon as you've done that mental accounting, you've already purchased a home in Kauai, an apartment in New York, a Ferrari, and the like. Chances are you wouldn't take that $5 million and go back to your company and purchase $5 million of just one company stock. Ownership of stock options can be financially life-changing, but most owners have overconcentration of their portfolio concentrated on one single stock, which is their company stock. This is dangerous because a greater portion of your net worth is tied up into a single asset, namely your company. No matter how well you think your company is going to do, it's extremely dangerous to do this. Despite the company's products or services or value that it brings, there's so many variables that you can't account for right now that could lead to a decline in your stock, which would be devastating to your portfolio. And I don't care what Jim says in sales.
Oh, this company's gonna take off. I've looked at the numbers. I know what I'm talking about. I've got a degree in accounting.
Fortunately, it's very easy to diversify as soon as you sell your shares. You might consider a low-cost, globally diversified ETF portfolio. And if you're told anything else, there's a good chance you're being sold something. Watch my video on how to set up a diversified portfolio. You may consider hiring a fee-only financial planner to help you set up a diversified portfolio, or looking into the apps like Betterment or Wealthfront. Risk number 1 of waiting to exercise until post-IPO is that the company could flop. Waiting to exercise post-IPO may be too late. Why? That's because not all companies take off on IPO. This is something that you have no control over. Even if you think that you know the product and know the numbers behind the company, there are just some things that are out of your control. There are many examples of companies flopping on IPO. Risk number 2 is that you risk paying more in taxes upon a successful IPO. In the comment section, let me know which company you think is gonna IPO next. If share prices skyrocket upon a successful IPO, that's great news. But you also may have more to pay in taxes. That just means a larger bargain element or larger spread that's calculated into your AMT, hence more taxes to shoulder. Even worse, if you become subject to disqualifying disposition, then you could have even more taxes to pay because you qualify for ordinary income rates, not the advantageous long-term capital gains rates. Risk number 3 is that selling right after an IPO could mean minimized gains. Once a company goes public, the price of the stock can decrease for a while just because all the employees start selling their shares. They all sell at once because the lockup period ends and they all want to recoup their investment. you can schedule an appointment with me down below for 30 minutes for free. This offer is subject to availability, so hustle to that link and schedule an appointment today. Did you find this video helpful? If yes, please share it with your coworkers on Slack or LinkedIn or via email, because there's a good chance they need help with their incentive stock options as well.